Hello, my name is Artūrs Breicis. I am certified tax advisor in Latvia. And in today's video, we are going to talk about alternative tax regime for dividends in Latvia, which were introduced as of this year. So, let's get started. The content of the video. First of all, we will look at the existing standard tax regime, which is corporate income tax at the rate of 20% on dividends payments. And then we'll look at the alternative dividend taxation regime, which consists of corporate income tax at the rate of 15% and personal income tax at the rate of 6%, which is applicable starting as this year. Let's see who is eligible to apply this new regime, because the old regime stays in place. This is a kind of alternative regime for the existing one. And let's compare how standard and how alternative tax regimes work, and what is better, what is kind of and how it works. First of all, let's revise the standard corporate income tax regime for dividend payments. So the tax regime which was before that and is still in use. So what is standard corporate income tax regime? As of 2018, the corporate income tax is applicable only on the dividends which are paid by the company. So until the profit is not distributed, the dividends are not distributed, the corporate income tax is not payable. So this is quite in contrary to the traditional corporate income tax, where the corporate income tax is payable on the kind of calculated results in accounting, which were adjusted by some adjustments, and then based on the calculations, the corporate income tax was calculated and paid in the budget. So currently, the corporate income tax is based on the cash flow, not on the accrual principle. So, in other words speaking, until the profit is not distributed, the profits are not subject to corporate income tax, and the company can use those funds for the business purposes, or just simply have these funds in cash or some vehicles, and without paying the corporate income tax. Of course, if the company starts to do the business expenses which are not connected with business, then of course corporate income tax is payable. But that's a different story. So we currently focus on the idea of the corporate income tax and how it works currently, in order to understand how the alternative regime works better or worse. So how does the standard corporate income tax regime works? The corporate income tax is 20% and 20% of the taxable base. But taxable base is not the same as the dividends which have been paid out to the shareholder. That's why the first step is that we get what the taxable base is. And for this reason we use the coefficient 0.8 and then apply a corporate income tax rate to this taxable amount. So the first step, we get this tax base, and then we get this corporate income tax. So let's look at the example. If suppose you have a dividends which have been paid out dividends, it's 1,000 euros. So you have been physically paid out 1,000 euros to your individual shareholder. So you have to pay the tax, but you cannot pay 20% out of the 1,000. You first step is that you get the tax base. And tax base is that you divide with coefficient 0.8 and you receive 1,250 euros. This is tax base. And then step 2, you calculate the tax. The tax base multiplied by 20%, you get 250 euros tax. And this 250 makes from the net amount, it makes 25%, and that's why sometimes someone is saying that corporate income tax rate is 25%. It's actually not true, because 25% you get when you apply it to the net base, but usually when you compare taxes, you compare corporate tax rate in relation to the gross base, so pre-tax amount. But still, of course, you can say also that 25%, but then you have to remember that this 25% is out of the net amount, not of the gross amount. So this is how the corporate income tax works. So let's get back to our slide, and then the next is an example, which we already kind of just a kind of continuation of this example. For example, if we have a profit and loss statement like this, we have earnings before tax 300,000. We have made the interim dividend payout of 100,000 euros. This is like in this example, 20%, 25% is corporate income tax, which is payable in the same year. So if this is profit loss statement, because and these are interim dividends but not the annual dividends, because if they were annual dividends, then they wouldn't be reflected here in the profit and loss statement. Then you would declare them in the balance sheet, and the corporate income tax expense would go to the profit and loss statement in the year when the dividends have been distributed. So, but on this example, you can see as interim dividends. This example, you can see that in this case, that 100,000 are paid out, 25% is tax, and net profit is the difference. Yes. What is the problem? The standard corporate income tax. So this is actually the tax. As you see, this tax regime is very beneficial for the. It allows saving of cash if you're not paying out dividends. So you save basically a big amount of cash, and when you pay out to the resident individuals, then resident individuals are not subject to any taxes, any other taxes, for example, some dividend tax or something. So if we make such a kind of drawing, yes, if we have a company, Latvian company, ABC SIA, and it has one shareholder, Latvian physical person or Latvian individual, yes, then ABC pays out those 1,000 euros. 1,000 euros, they pay 20% out of the 1,000 euros, let's say, and the 80% goes to Latvian individual shareholder, and that's it. So basically, there are no other taxes. But if we compare the same situation, we have this company XYZ CEO, which pays out to Latvian non-resident, for example, resident of Lithuania. Then again, Latvian company pays 20%. This Lithuanian resident receives 80% out of those dividends, but still he or she must pay something in Lithuania as a dividend tax. So that's why there is a kind of discrimination. It's because for Latvian residents, this regime is much more beneficial compared to some other compared to non-residents. And the point is that all this corporate income tax is regarded as corporate income tax, but not as dividends tax or some personal income tax, and that's why resident in Lithuania is not eligible to get a tax credit for the amount of tax paid in Latvia, nor use somehow else this tax paid in Latvia. So that's why the overall tax burden for other non-residents would be higher than compared to Latvian residents. Yes, so, and that's why our government was aware of it, of course, and that's why they tried to, at least tried to make those things more smooth for also for non-residents, and to make them more beneficial for non-residents. And that's why the new alternative corporate income tax rate system was proposed and included in the law. So as of 1st January 2026, the individual shareholders may choose whether to apply the previous system or apply alternative system, which consists of 15% corporate income tax, which is paid at the company level on distributed profits in the same way as currently 20%. But in addition to pay 6% personal income tax, yes, but this income tax is withheld from dividends paid to individuals. So in the first step, company pays out dividends and pays those 15%. In the second step, out of those paid dividends, company withholds 6% personal income tax and remits the difference to the shareholder. We calculated that effectively, if the under standard tax rate, the effective tax rate is those 25%. Then, if we apply alternative system, then effective rate is a little bit higher. It's 25.16%. That's because you first deduct. Not deduct, but you first pay those 15%, and then you deduct those 6%, and then by this is not like we cannot count those together, like 15 plus 6, it's not 21%. It's still something between 20 and 21, but effectively this new alternative rate is a little bit higher than traditional, not traditional, but like standard rate. But what is the benefit, we will see in the next example. So by applying this alternative rate, the first step, the coefficient of 0.5 is used, and this is calculated like 1 less 15%. Yes, this 0.85. Like in a standard situation, it would be 1 less 20%. It's 0.8. So, and the idea of this alternative system is to balance the tax burden between local and foreign investors. So foreign investors will pay a little bit more this personal income tax in Latvia, but then he receives a credit in the country of his or her residence. So basically he pays 6%, and those 6% could be credited in his or her country of residence. And then by deducting this 6% of the dividends tax payable in his residence country, there is not very big benefit, but at least some benefit compared to the previous standard system. So yes, and who can apply this new alternative tax? First of all shareholders should be individuals. It doesn't apply to the shareholder companies. Yes, and everyone must agree that the alternative system is applied. And the alternative corporate income tax regime should be applied throughout the relevant tax period. You cannot switch from one to the other within 1 year. And the alternative rate is not applicable to the non-business expenses or other profit distribution except dividends. And also it cannot apply to the profit which is generated before the 1st January 2018. Yes, because this is so-called the old profit, which is calculated based on the different grounds and principles. So how does it work? In real world life, let's see an example, and you will see how it works and whether it is beneficial for you or not. So standard tax regime, how does it work? So first of all, we look already at this example, but once again, if the company has a little bit from different angle, if the company has a profit and loss profit before tax 1,000 euros, and it decides to distribute all the profit and pay also tax in order to get a zero balance of the profit. So this means that if we have 1,000 euros profit, we can pay out 800 as a dividends, and 200 should be payable as a corporate income tax. So here we pay 800 to the shareholder, and we pay 200 to the state budget. For us, it's for Latvian company. That's it. But for the non-resident individual, it becomes a question whether these 800 euros are taxable in his country of residence or not. We look at Lithuania as an example, where the dividend tax is 15%, meaning that this dividend receivable by this Lithuanian tax resident is taxable with 15% personal income tax. So basically, this means that this individual has to pay 800 times 15%. It's 120 euros to the state budget, Lithuanian state budget. And altogether, he receives net dividends of 608,000. So the rest goes to the as taxes to Latvia and to Lithuania. You see that the problem is here that all the corporate income tax payable here in Latvia, it stays in Latvia and it couldn't be deducted from the tax paid in Lithuania. So the alternative corporate income tax regime tries to balance it. And what it basically says, it says that first of all you pay this corporate income tax, 115 euros, like 15%. And then the difference between that is 850, and you pay. Company has to withhold 6% out of this dividends payable. So 51% goes like personal income tax, and 150 as corporate income tax. Yes. So dividends payable is less than previously. As I said, that this alternative system is a little bit higher risk effective rate. So non-resident receives 799 euros, and then it calculates 15%. It calculates 15% out of the dividends received, but not received, but dividends declared, because the dividends payable out were 850. So actually paid dividends is 799, but declared dividends are 850. So he pays 15% of the tax in Lithuania. This is 127.5 euros. From this, but in this case, in Lithuania, he has right to deduct this 51 euro, which is paid in Latvia, to deduct it as a tax credit. So at the end of the day, he has this deduction and has to pay in Lithuanian state budget 76.5 euros, not 120 as previously, but much less. So in this case, he receives net dividends are 722. If we compare with previous, here are 680. So the difference is about 40 euros. Of course, on 1,000 euros, it doesn't seem very much, but it's quite considerable difference. So as you see, that this balance is achieved by crediting, like taking out part of the Latvian tax, converting it into the personal income tax, and then that gives a right for the recipient to use it as a tax credit. So comparison between standard and alternative system. Actually, as I already covered everything, but yes, the main difference is that, as I said, the 6% is qualified as personal income tax in Latvia, and it is credited in as a foreign tax credit, or serve as a base for the exemption from the tax. It depends on the double tax treaty. You have to look on the double tax treaty about the method of elimination of double taxation. Of course, standard corporate income tax is much a little bit easier. It's like company pays 20% tax and that's it. And for local residents, I don't see any reason to select alternative corporate income tax because it's a little bit higher rate. But the only thing which is if we look from the local perspective, is that those 6% goes to the local government budget. So if you are kind of patriot of your local government, you can switch to this alternative regime, and by hoping, or not hoping, but relying that part of the tax is paid directly to the local government budget. For the foreign individual, it is obviously this regime is more beneficial than standard corporate income tax regime, and it is advisable to choose it, to select it, unless you are resident in the country where are no dividend tax on the there are no dividend tax. So if the dividends are exempt from taxation, then there is no reason to select this alternative corporate income tax. But since in most countries there is a dividend tax in existence, so basically then this regime is more beneficial. So thanks for watching this video. If you have any questions, please don't hesitate to contact us, and see you soon in the other videos. Bye bye.